Buying a house? You need the right type of home loan for your money situation. The two most popular kinds are FHA loans and conventional loans. They have different rules, different costs, and different benefits. Choosing the wrong one could cost you thousands and thousands of dollars. We'll explain both, so you can pick the best one for you. By the end of this video, you'll know exactly what to ask for when you talk to your lender. Let's get started. FHA stands for Federal Housing Administration. The FHA doesn't lend money, they insure loans made by approved lenders. This government backing lets banks offer loans to buyers with lower credit or smaller down payments. FHA loans were created to help people who might not qualify for traditional loans, especially first-time buyers, or those with less than perfect credit. You can get approved with a credit score in the high 500s, and as little as 3.5% down. But there's a catch. You pay for mortgage insurance, which protects the lender, not you. That insurance is added to your monthly payment and can be costly. FHA loans open doors, but you need to weigh the convenience against the long-term cost. Let's look at the pros and cons. FHA loans are forgiving on credit. Scores as low as 580 can qualify. The low down payment, just 3.5%, makes homeownership possible for many who can't save 20%. Higher debt-to-income ratios are allowed, so student loans or other debts aren't automatic deal breakers. FHA loans are often assumable, meaning a future buyer can take over your low-rate loan. This can make your home more attractive if rates rise. For buyers with limited savings or imperfect credit, FHA loans are a lifeline. They're designed to help you get started, not keep you renting forever. But remember, flexibility comes at a price. Let's talk about that. The biggest drawback? Mortgage insurance, required upfront and every month. If your down payment is under 10%, you'll pay that insurance for the entire loan term. Unlike conventional loans, you can't cancel it once you build equity. Over decades, this adds up to thousands in extra costs. FHA appraisals are stricter, so the home must meet government standards. Delays and repairs are common. There are also loan limits, which can be too low for expensive markets. FHA loans are only for primary residences, not vacation or investment properties. You must live in the home. In short, easier approval, but more long-term costs and restrictions. Now let's see how conventional loans compare. Conventional loans are the standard, no government insurance, just you and the lender. Because lenders take on all the risk, they want higher credit scores, usually 620 or above, with the best rates for 740 plus. Down payments can be as low as 3%, but you'll need excellent credit for that. Most buyers put down 5-20%. The more you put down, the better your terms, and the less you'll pay in insurance. Conventional loans reward financial discipline with lower costs and more flexibility. If you qualify, they're often the smarter long-term choice. Let's look at the benefits. The biggest perk? You can avoid private mortgage insurance, PMI, with a 20% down payment. Even if you pay PMI, it drops off automatically once you reach 78% of your home's value. That means lower monthly payments over time. Conventional loans let you buy second homes or investment properties. FHA doesn't. The appraisal process is usually simpler, with fewer repair demands. No upfront insurance premium, so you borrow less from day one. Sellers often prefer buyers with conventional loans for a smoother closing. If you have strong credit and savings, conventional loans save you money and offer more options, but they're not for everyone. The main hurdle is tougher qualification. If your credit score is below 620, you'll struggle to get approved. The best rates go to those with scores above 740. Down payments under 20% mean you'll pay PMI until you build enough equity. Debt-to-income ratios are stricter, usually capped at 43%. Major financial setbacks like bankruptcy or foreclosure mean longer waiting periods. For buyers with limited credit or savings, FHA may be the only path, but if you can qualify, conventional loans are usually the better deal. So which loan is right for you? It depends on your numbers. If your credit is in the low 600s and you have a small down payment, FHA is your bridge to homeownership. If you have strong credit and a big down payment, conventional is the clear winner. Lower costs, more flexibility. FHA is about short-term access, Conventional is about long-term savings. If you start with FHA, make a plan to refinance into a conventional loan once you've built equity and improved your credit. Don't just settle, use FHA as a stepping stone. The goal is to eventually own your home outright with the lowest possible costs. Know your numbers, weigh your options, and choose the path that fits your life. Both loans can work if you use them wisely. The key is to be intentional, not impulsive. Let's wrap up with some final steps. Before you talk to any lender, get your finances in order. Make a budget, pay off debt, and build an emergency fund. Check your credit reports for errors and work to boost your score. Get pre-approved, not just pre-qualified, so sellers know you're serious. Shop around. Compare offers from banks, credit unions, and brokers. If possible, choose a 15-year fixed-rate mortgage. It saves you a fortune in interest. If you must go 30-year, keep your payment under 25% of your take-home pay. The goal isn't just to buy a house, it's to own it, free and clear. Whether you choose FHA or conventional, make your decision with confidence. That's how you win with money and build real wealth. Like, share, and subscribe for more housing insights.